I've always been working closely with students, so this means that I reviewed their works. And there is one unexpected problem that they have. This is their confusion between financial asset and financial liability. So first of all, pay attention to what side of the story you are on. Whether you are borrowing money and it's going to be a financial liability, or whether you are lending money and it's going to be a financial asset, which is investment in debt instruments. And out of that, we have the next problem. This is the types of accounting. When we're going to talk about financial liabilities, then the default way, which is default, so it doesn't require any justification either other than that this is default, is amortized cost accounting. But when we're talking about financial assets, there is no default way. So you have to apply the two criteria, which is the cash flow test and business model test. So with the financial assets, you will have to say that the cash flows represent only the repayment of interest and principal, so cash flow test is passed. You will have to say the business model is to hold the asset to maturity, so this means that this is going to be accounted at amortized cost. So with financial assets, we have to give these two ideas in order to get marks for the recognition. With the financial liability, you just say by default. With the financial liabilities, we sometimes have instruments that are going to be accounted at fair value through P&L, but I would remind you that this is a very rare case. So this would be, of course, when we have a derivative, and derivative can be a liability, so it can be fair value through P&L. And other than that, when we're talking about normal instruments, these are financial liabilities that are held for trading. So this is, for example, when a company issues bonds, but it expects to repurchase and sell them. In this case, it's going to account for it using fair value through P&L. Can we use fair value through OCI for our financial liabilities? Well, frankly speaking, we can if it is a part of cash flow hedge, or if it is a part of fair value hedge where the instruments that we are going to use is going to be used against hedged item that is accounted under fair value through OCI. But it's kind of like an exception. So when we're talking about methods of accounting, we don't really talk about fair value through OCI. We talk about the fact that amortized cost is default and that fair value through P&L is used sometimes, but not so very often. And that is the thing that you need to keep in mind, because these are easy marks and also it's an easy mistake to make, and that mistake is going to make the rest of your answer irrelevant. And I will see you next.